when it comes to swing trading, for us to feel confident and be on the right side of trades, we always want to wait until stocks come down below their moving average, start to have a clear reversal pattern to then enter. So if we're looking at Sunrun, which is a huge solar energy company, they're in Costco, which is big in the United States. I don't know if they have Costco in the UK.
Yeah, they do.
They do?
Yeah.
Okay. So in at least all the booths near me, like at Costco, there's booths at the exit and the entrance. And they have Sunrun tables set up, and Sunrun installs solar panels into your home. And they're one of the big companies. And so being in Costco is going to, get them a shit ton of revenue. This is going to be a big player because, going forward in the future, what companies are we seeing do really well in the stock market? Well, it's like green energy, electric vehicles, cannabis, things like that. U.S. cannabis companies, electric vehicle companies, Neo, Tesla, big tech companies. We're seeing all these companies do well. So these are the things. These is obviously the future. So we're investing for the future in companies like this. And when it comes to the swing trade, you never want to buy stock when it's above the 20 MA. Why? Well, because look, if you look at that Sunrun and you see here the top at $82, and you take this $82, but if you go all the way down here where the 20 MA line is, you're going to see it's at $59. So here you are purchasing shares for $52 when the moving average is all the way down at $59. So of course you're going to lose money, right? Because you're paying 30% more, 40% more, 50% more, in some cases than the average. So of course you lose money. Anytime you get way above that moving average, it's over bought, and so it has to come back down to that moving average and actually dip below it and then reconsolidate before it now changes the trend, finds support, and reverses. So as you can see here, there's a low, there's a high, and then now you have a higher low. So you've established support here in a positive trend. Like when it comes to like basic technical analysis, lows and highs, as you trend up, you have a series of highs, lows, higher lows, higher highs. As you downtrend, you have a low, you have a lower high, low, lower high, low, lower high. That's what sends a downtrend. So now, as you can see, we reverse. We no longer had a lower low. We now had a higher low. And that's the beginning of this reversal. That's why I said, purchase some Sunrun at 56 for a quick swing trade. Have my stop loss at $52. Now, where does this $52 stop loss come from? Well, $52 is this, if you were to zoom in on the bottom of this candle, that's where, here, let's see, can I open this? Okay, so if I open this, I can zoom it in here for you guys to see. So where?
I don't know if I can see the other window. It's still showing you a Discord.
Oh, it's showing my Discord? Okay, hold up.
Yeah.
Hello?
Yo, so hold up. Okay, now you can see my entire screen.
Yeah.
Okay.
Quick question.
Yeah.
Quick question.
Uh-huh.
The moving average when it's below, like say you're looking at it like by the minute versus the daily, and the moving average is below, but then when you go to daily, it's like
it's going to be different. So
above. Does that make a difference?
Yeah. So you have to.
And whether or not you would.
Sorry. Can you hear me?
Yeah.
Okay. Yeah. So it's different. So right now I'm teaching you guys how to swing trade. Swing trading is way different from day trading. When we're day trading, we are using the 1 minute chart, the 1 minute candlestick chart. And that's completely different. So when it comes to just investing, like let's say we want to figure out a good opportunity to buy calls for a company or to buy puts for a company, right? With options, we either are betting the price goes up with a call or betting the price goes down with a put. So when it comes to that, when you're a beginner trader, you're not a day trader. You have to work up to that. So the first step of becoming a day trader is learning how to swing trade. learning how to swing trade stocks, learning how to swing trade options. So if I'm looking at, this chart, where would you short it? Where would you bet the price goes down? And then where would you bet the price goes up? Well, obviously, when we're looking at this chart, look how far above we are above this purple line, above this moving average. You're up here at $82 and the moving average is all the way down here at 59. This would be a good time to short or buy puts on a company. Bet the price goes down, right? Because look what happens. The price came all the way down here. Now when would be a good time to buy calls on a company and bet the price is going to go up? Well, about right here is looking like a nice reversal, because here you got an initial surge. It came back down, established a higher low, and is now starting to trend back up. So if you're buying, call contracts a couple months out and just overall, and then going to cash out when the stock price starts to go up, this would be figuring out how to, how you're looking at a chart and to figure out when it would be a good time to enter. If it doesn't matter what chart we're looking at. Twitter did the same thing. Look at Twitter. Look how high Twitter got above its moving average, $52, but the moving average was all the way down here at $42, $43. Now it crashed all the way down to 38 and then started to build back up. That's also, and it's, now you can see it's coming back to this purple line, coming back to the moving average. So that's why I was saying, if you buy some shares and hold it for a couple weeks, you have a way higher chance of making money on Twitter than losing money, because you're buying when it's low and it's below the moving average and it's trending back up, versus, buying it above the moving average. Of course, you're going to lose money. That's a terrible time to buy stocks or invest. You should be shorting companies and betting the price goes down when you see this. But keep in mind, options is gambling, so you have to be smart. You have to have stop losses on all your trades. So every single trade that I send you guys in the group, whether it's an options trade or a swing trade that I feel confident on for you guys, they're all going to have stop losses. All the options trades, 10 to 15% stop losses. It's the same thing with the swing trades. Does that make sense to everyone? Is that something new for you guys? I mean, I know Kara, you've gotten some of that, but what about you, Martin? Is that new to you?
No, I'm understanding it. Like I've been researching this stuff over the past 6-7 months, and I'm just about to start entering trades and stuff like that. So I feel, and Chris Johnson and stuff always spoke about moving averages and stuff like that. So
So I mean, the key tools that I use as a trader is the moving average and the RSI, which is the relative strength index. So as you could see here, this here, let me pull up this picture because it's bigger. So as you can see here, underneath the chart, I have the RSI, which is right here underneath the chart. Notice, keep in mind, look at this orange line. You see how high it is when the stock price is the highest, okay? And then now look at this orange line when the stock price is the lowest. So how do you correlate those two things? RSI is the relative strength index, meaning think of it as a fuel source on a stock, okay? As it starts to run hot and get to high RSI above 70, you're starting to run out of fuel. You have to come back down, refuel before you can head back up. Okay, so notice now this next spike that it got, when it fell to here and then spiked back up to here, you see the RSI was low and then spiked back up. This is the RSI 2, so I'm looking at if I'm looking at, this is the 2-day RSI. The 14-day RSI is the big boy. That's what you use overall. That heats up from 30 to 70, 30 to 70. The RSI 2 is going to be more of your day trading RSI indicator. That's going to be jumping from 0 to 100 or 10 to 90, 10 to 90. So I'll get into a little bit of that as why we use multiple RSI indicators to trade when it comes to day trading, but you're using both of those. Just, make that correlation.
Am I the only one that it's
what?
cutting out really bad?
Is it cutting out for you, Martin?
Hello?
Kara's voice
It's
is
cutting out really bad. It may just
Kara's voice, but am I cutting out?
Okay.
No, you're
Okay.
clear for me.
It might be your connection then. I don't know. But all I was really saying was when the RSI is hot, that's when it's oversold. It's ran out of fuel. It has to come back down to earth, and that's what ends up happening. Okay, so now if we go to the Robinhood and we just open up options, I'll get you guys to understand the options chain. Okay, so like I was saying before, options, here, I'll take out a sticky note. So options are the right to buy or sell 100 shares at a specific date, expiration, for a specific price, strike price, okay? Options is similar to gambling. You are betting the price goes up with calls, or betting it goes down. Those are called puts. Okay, so keeping this in mind, option is the right to buy or sell 100 shares at a specific date, expiration, for a specific price, strike price. Okay, so what do I have here? I have my strike prices on the left. I have my buy, a call, which is betting the price goes up, or a put, betting the price goes down. And then I have my expiration dates. I can choose a date, right? So when I pick a date, like let's say I pick a random date, December 24th, okay? Now what is this price here? This price is how much it costs to buy this bet, right? To buy this call or to buy this put. This is how much it costs. So we're going to switch to calls, okay? So this is a $500 call. So what does this mean, okay? I am betting that Tesla is going to be $500 or higher by December 24th on expiration, okay? But now if I go to purchase this and I go to continue and I type in to buy one contract, it comes out to $4,750. Where is this? Why is it, this says $47. Why is it $4,750? It heads back to this whole idea is options is the right to buy or sell 100 shares. So one options contract controls 100 shares. So options contracts trade for 100 times the price. Okay, hopefully that makes sense. Okay, so the price for this option is $47. Okay, so where does this all come from? Okay, because now this expires December 24th, so we have what, a whole month? Tesla could run a lot higher than 500, right? Tesla could be 600. So there's obviously a value, there's an inherent value in having this bet, right? Because if you purchase this bet and it ends up going way higher, you're going to make a lot of money. So there's a value in this option. This value in this option is $47. You're having to pay an extra $47 on top of making this $500 call. So that's where this break even comes from. So in theory, if you were to purchase this contract and then wait until expiration and allow it to expire and you fulfill the contract, you are now purchasing 100 shares of Tesla on December 24th for $500. Obviously, you don't have to do that. and you can obviously flip the options and sell them before expiration. I actually recommend everybody gets rid of their options before expiration. We're just flipping the options for profit. We don't want them to be expiring because there's always risk. If your option expires out of the money, you're going to be left with, all of this money that you paid for it ends up going to zero if you hold it until expiration and it expires out of the money. What is out of the money? Out of the money is anything that's above the current share price. So current share price $4.94. So if you scroll up, all of these contracts would be considered out of the money. If you go under $4.94 and you scroll down, all of these contracts would be considered in the money. Notice, as you get in the money, options begin to trade for their true value, right? So if you have a $300 call and you bet the price of Tesla is going to be $300 by December 24th, well, obviously, it's already profiting, right? Like, you're already in the money. It's already like 90% chance that it's going to hit. Well, that's why if you purchase this $300 call, it also costs an extra $200 per share, which will give it a break even of $500. And look at the share price. It's about the share price. So as you get super into the money, or as you get to expiration, all of the in the money contracts go to the proper price. 300 plus 200 equals 500. The reason why these contracts are trading for, these, right? If you're purchasing an out of the money contract, in theory, it should be free, right? It should be $0. You're betting that it's going to go to 600, you're betting the right to buy for 600 when it's 500. In theory, why are you buying shares for 600 when it's 500? Well, because you're implying that the price is going to be much higher by this expiration date. So that's where the value comes from. And that's why all of these out of the money contracts have value. And this is what you would consider like premium or inflation. There's premium on these. You're paying an extra $50 premium on this contract versus if you scroll all the way down here to this $300 contract, you're only paying like a $6 premium, right? You have a 501 break even, and that's only $6 or $7 from here. Versus when you're looking at these out of the money contracts, you're paying an extra $49 versus an extra $6. Obviously, you need now $24,000 to buy this contract. That's why most people aren't buying these contracts. But if you're talking about safety and less volatility and less risk, you want to be buying in the money contracts because, like, let's say this $480 contract is $56. If Tesla falls $10, you're going to lose $10 on this contract, which would be $1,000. It would go from $56 to $46, $10 loss. We have to remember a contract is 100 shares, so it's multiplied by 100. $10 loss multiplied by 100 is 1,000. Okay, but if you bought this out of the money contract for $40 and now Tesla dropped $10 to $480, this contract would lose more than $10. This contract might lose $20 and lose half of its value. So that shows you the difference. Here you're losing 50% if it falls and you're wrong. Buying out of the money, you lose 50%. If you buy in the money, you might only lose 20% or 10%. That gives you an idea of the risk involved buying out of the money contracts versus in the money contracts. Does that make sense to anybody? Is it Martin?
Yeah, sounds good.
Is that new to you? Is that stuff you all knew already?
Like, I don't know. It's just like refreshing.
Refreshing? Okay.
Yeah.
Awesome.
That's good to hear, though.
Awesome.
100%.
So when I look at a contract, there's a couple things you want to look for. What is this delta? The delta means every single dollar that Tesla goes up, you're going to make $57 on your contract. For every dollar that Tesla goes down, you lose $57 on your contract. Keep in mind, you're buying this for $5,000. So there's a this contract moves at a 0.57 of a dollar according to how Tesla moves. So that gives you an idea of, like, let's say you buy these contracts and you buy this call for $4.95, betting that Tesla is going to go back to $500 to test 500. Okay, so you're gonna swing trade this option from $4.95 to 500. So that's kind of where this all comes together. Learning how to swing trade, then incorporates, starting to learn how to swing trade options, how to day trade. You're using all the same analytical tools, the same decision making that you would make to invest in a stock is the same type of things you would do to do options. It's a similar mindset. So if I'm just swinging this for $5, if Tesla goes up $5 in price, my contract is going to go up at least 0.57 of $5. So at least $250 I will make if Tesla goes up $5. That's on this contract. It obviously has a month expiration. That's why it's not moving dollar to dollar with Tesla. If you pick something that expires very soon, you're looking at like November 27th expiration. These delta is obviously, it's not significantly higher, 0.59 versus 0.57, but it will be more as you get closer to November 27th expiration date. It will move closer to like a 1-to-1 ratio where it will be like even. And then when you look at the theta is like your implied risk. Okay, so anything that's above like 1, that means you have a high risk. So as we go super low down here to like 400, it's going to have a super low theta. Look how low the theta is, 0.18, because they're saying that there's a much lower risk that if you buy this $400 option, that it's going to expire out of the money. That's kind of like the higher the theta is, the more implied volatility, the more implied risk when you're just looking at options. So these are just some things to keep in mind.
So just to cover what you said before, so if the delta was like 0.97, for example, that would be like for every dollar Tesla goes up, you could be making $97 or losing.
Yeah, so think about it this way: like a contract is 100 share is the right to control 100 shares. So a $1 move should influence your contract $100 if it's trading. If the delta is 1.0, a $1 move will affect your option $1. Because we still have time on these contracts, so like when I'm day trading my options, when I get a $1 move, I'm getting like a $60 profit, because you can see these deltas are like 0.6. But then there's also going to be more of that inflation and hype, because Tesla's a hype stock and a lot of people are trading the options. Now you also have premium. So the delta might be 0.6, but then if you include premium, it might boost that delta to 1.0. So especially when you're trading options that are weekly and expiring this week, your delta is going to be almost 1. So keeping that in mind. But yeah, if you want if you check out my last YouTube video that, I don't know, did you watch the YouTube video I posted today?
No.
Okay, so I just posted this video, made this on YouTube. If you go to YouTube, scroll down. This video will go over essentially like what I'm looking for when I'm day trading options. This is one. All of these essentially would be good to refresh, but I'll just give you a little bit of an example right here. If I go to TD Ameritrade, we go to our order book today, and I'll go to Webull. So just to like break down this last trade and kind of get you an idea of like how things are going. So we'll go over this trade done at 10 o'clock and then done at, so it was a 4-minute trade. Okay, and as you can see, we bought 5 contracts for $18.90, and then 4 minutes later, we sold the 5 contracts for $19.60, so a total profit of $1.30 per contract, which would be $130. And then we did 5 contracts, so it'd be $650 total profit on this trade in 4 minutes. So I'll break it down real quick. So this trade was done at 10:05, and on Webull it's going to be like 11:05, I think. Let's see. Okay, there we go. Okay. So here I'm looking at the 1-minute candlestick chart on Tesla. And if you go to our order book, we purchased 5 calls, 5 $500 calls for this week at 10:01. So if we go to 10:01, what did we see to make us buy the calls? Okay, you see my mouse and you see how it indicates the time underneath, 11:19, 10:01. Okay, so you see how that's also 10:01, 10:02. That's also when the RSI is the lowest. It's like on the RSI 2, it's like at a 5. Okay, and that's also, this is like the bottom here. You see how it's the bottom of this candlestick, the lowest it went right here. That's when we entered the calls. We purchased it, and then at 10:05 we sold them. So now we go to 10:05. Okay. So obviously, look, I could have held this trade so much fucking longer and made like $5,000. Yeah. Seriously, because it jumped another $10. Okay. But as a scalper, I day trade, I scalp, I take my profit when it's there, and I exit my trades when they don't end up working. So that's just what works for me because of my personality type and just I've been stubborn in the past. I have to day trade like in and out of the market. And that's the best way I think to trade anyway, is to scalp, because you go in for a couple minutes, you go out for a couple minutes, you secure your profit, and then you pull all your money out of the market. So it doesn't matter if the market crashes or if the market rallies the next day, because you're just scalping, you're just day trading. So that's what I'm doing is, 4 minutes later, I was up $650 in 4 minutes. That's enough for me to be like, okay, I'm going to take this. Ended up running again, but I'm not going to like FOMO, right? It's like once you know how to trade, the battle isn't, can you do this? Are you a good trader? The battle is against yourself, your psychology, your greed, your emotion, your patience. That's what it comes down to. The tools that I teach my group and that I'll teach you, because I don't know if you decided to join, but I know you're in the Wealth Squad, but our group is $11 a month, and this is what I'll get everybody to, is to get them to be able to do this, and then you take, it prevents you from losing money. You're never gonna, essentially, you could be up, I'm sure you might have invested in the past where you were up a lot of money and then you gave back all the profits and you're wondering, what happened. Well, that's because, you bought Tesla, it ran up all the way, you didn't sell your shares, and it crashed all the way back down to the moving average. This is Tesla chart. This is, look at all the times. Look at how it interacts with this 20-day MA. Now I'm looking at the daily chart. I'm looking at a big time frame. I'm no longer looking at a small time frame. Look at how much, And so this is how I knew Tesla was going to break all-time highs today. And the trades that we were doing today, we were buying calls mostly because we were planning for that all-time high break. And that's what we ended up getting. Right now, Tesla's a different beast. It's probably one of the hardest stocks to trade because it doesn't always stick to, it strays from like the core formula. Whereas if you go to like other stocks that are more normal, like Apple stock is going to trade much more stable, much less volatile. Tesla is a beast. So sometimes it will just rally and run and run and run and run and run. And so that's what Tesla has always done, is it's always been a beast when it comes to bull runs. So you always want to be on the right side when it comes to these, catching these bull runs. But, even when you're looking at this stock price now, why did you get this huge bull run? Well, the chart, obviously the S&P news, we got the S&P news, but also it touched the moving average, right? Because look at all these other times Tesla stock gapped up, came back down, consolidated at the moving average, dipped a little bit below, ran back up. You got this again, dip below, consolidated at the moving average. Now we're getting another gap up. So we could see Tesla, run up to $600 potentially on all this S&P hype, but then eventually it's going to tank. It's not like it's going to run up forever. But this just prepares you to be a good trader. Take your profit when it's there. Don't go long when you're way above the moving average. The next thing you want to keep in mind is like, here's this, we downtrend, low, lower high, lower low. Now you have a high, you have a higher low, you have a higher high, positive W reversal. You see this across the stock market on all stocks that were good and ended up reversing and finding bottoms. So the next time a pandemic hits, don't get fooled out. Don't get fooled out until you see this confirmation of reversal. Now you can purchase shares. And look, you just, you fucking made a killing. You're up 10x if you bought coronavirus lows, fucking dropped to like $60. So, but for sure, bro, that's all I really got for today. Unless you have any specific questions I could answer.
Yeah, if you've got like 5 minutes.
Yeah, totally. 5 minutes. Yeah.
Like outreach, but I've just started set up like an options account. Obviously, in the UK, it was hard to find like a broker that I could like trade options with and stuff like that.
Yeah.
Do you know the difference between CFDs and options? Because I see a lot of stuff in the UK advertising CFDs, and I made sure to find one that was doing options because I wasn't sure what the difference was between them both.
Yeah, if CFDs, yeah, so this is like, so CFDs are like futures. It's very similar to options. It's contracts. Yeah, I mean, I've never specifically traded CFDs, so I can't like give you 100%, but that it's basically what I'm reading here and what my gut tells me is a very similar thing to options. It's essentially like futures. If you've heard of futures in like the Forex market, futures on oil, on gas, futures on gold, on the US dollar. So futures is like the Forex equivalent of the stock market's options, which is like probably similar equivalent to CFD. But if there's like a broker that will actually let you trade real options, I would definitely do that versus the CFDs, because the CFDs might be a little bit different.
Yeah, I've just signed up with like Tastyworks and like put money into like it was a bit of effort like finding a broker that could sort that out. But if I could like show you my screen for a second if possible, because when I try and like sell and trade, like everything's really confusing, and it just like brought me away from it because I didn't know what I was doing. Really.
Sure. Does it let you share screen in this one?
Yeah, let me just let me just log into the platform quickly. Fine, just making me confirm something that an email quickly. Alright, yeah, let's try this one now.